Well, happy Monday, everyone. Welcome to our Straddles and Strangles webcast. I'm Connie Hill. Happy to have you joining me here today. Last week we started this class and we went with straddles, which we mean we're looking for a big move in the price of the stock. Well, today we're not going to take that approach. We're actually going to take the approach of what if we don't expect a huge move out of the stock, okay? So that's going to be our strategy of focus here today. I'll give you more details as we get into it. Now I am joined in the chat by Brent Moores. I'm so glad Brent is here. He's here to help me maybe fill some of the questions that I can't quite get to, but we want to know what your questions are. So tell us, go ahead, chat those in. If there's something that may be a little off topic, Brent might be able to handle that, or some other questions I can't quite get to. Now, I also hope you're following us on X. My handle is Connie Hill CS. Brent is Brent Moore CS, and we'll post educational content out there, things that we happen to notice in the market or charts, things that are going on that we think you might want to be aware of. Then we're going to go ahead and let you know about it. All right. Let's go through our disclosures, and then we'll get into our agenda here today. Options carry a high level of risk and are not suitable for all investors. What we talk about today is for information and educational purposes. Don't consider it a recommendation of any sort. We'll be using the Paper Money software application. This is what you download to your computer. It's the most robust version of Thinkorswim. When trading option strategies at or near expiration, make sure you're considering a specific risk in terms of lack of liquidity, price slippage, volatility, things of that nature. Investing involves risk, including the loss of principal. There is no guarantee that an execution of a stop order will be at or near your stop price. It just competes with other incoming market orders. The idea is to get filled right away. Past performance is no guarantee of future results. One thing I need to make you aware of that's different in Paper Money than in your live account is that Paper Money does not assign early. That's an important thing for option strategies because I don't want you to get a false sense of security. So if something like that happens, I'm going to kind of point it out to you that, hey, this didn't happen in paper, but in the live account, it really certainly could happen. All right. Want to make you aware of events coming up through the end of the year. Anaheim Market Drive event, which is one day on a Saturday. Houston is going to be a workshop, technical analysis and options on the 11th and 12th of December. And then on the 19th, we'll have our last advanced options workshop for the year. That's going to be in Miami, where it's nice and warm. And Houston and Anaheim, I think, are going to be a little bit warmer than where I am right now. Maybe they'll be warmer than where you are. And I kind of like being warm. I don't like being too cold. Now, what I want to do today is look at our previous trades that we did last week. Just do a little update on them. Quite honestly, not a lot has happened with them. I want to spend the rest of our time focusing on a strategy called short straddles. Last week we did long straddles. This week we're going to talk about doing the short straddles. So let's hop over to my Paper Money here. And we just have two trades on. We have on IBM and Texas Instruments. Both of them happen to be up a little bit right now, although you can see they were up higher first thing this morning, right? Because Texas is down 127, IBM is down 80, which means earlier today they were up quite well, okay? Let's take a look at their charts and see what the deal is. We'll deal with IBM first here. The reason that we're up on IBM is because of this decent size move in the price of the stock, right? We had kind of a decent sell-off on Friday. And so what happened to our values? Our call option values, they went down. Our put option values actually went up quite a bit. And probably the implied volatility probably went up a little bit in both of them because of that hard sell-off. So on Friday, when I was looking at them, both positions were actually not both positions, but both ticker symbols were up. But say on IBM, if we come and open it up, we're going to see the call option on top is the one that's lost quite a bit. We paid $11.80 for it. right now it's worth 630, but our put option, look how much that's gone up. That's when it has gone up almost $7. And so that's really where the big profits are being made, is in that option. Now it's the same thing with Texas Instruments here. Last week, we had a hard time getting filled on Texas Instruments. In fact, one of you in the class mentioned that. He said that is having a hard time. All right, so we have one call, one put, basically is what makes up a straddle. They're usually the same stock price or strike price, and that's what IBM was. Okay, these were both 290. Since we had a hard time getting filled on it, I went ahead and said, okay, there's more liquidity out of the money. And so I actually changed our trade on that one, and I put in a strangle, which is you're going a little bit out of the money rather than right straight at the money. So the straddles, same strike price. Strangle is two different strike prices, and typically both of them are a little bit out of the money. So that's what we ended up getting filled on with Texas Instruments. Now, again, we can see the price on this. It's definitely the put option that is making us have a profitable position here, because the call option certainly went down quite a bit. Now, as both of these don't even announce until next week. And that was part of the strategy last week, was buying these in time that implied volatility could ramp up a little bit, and that would help these long options. Okay. It also will help our strangle, right? Implied volatility going up is going to enhance that in a long position. So we're just going to let them play out. We're going to still be in them. The earnings date, let's just go kind of verify that, see if those have changed. So the 22nd is going to be next Wednesday. So my expectation is we're still going to be in these trades come next Monday. All right, and that's part of our strategy on this one, TXN. I think their earnings might be this. Let's see if they're the same day. Yeah, nope, this one's on the 21st. So this one's going to be on Tuesday. So a week from tomorrow is when these guys will announce after the market closes. Okay, so when we get back to our class, I expect us to be in both of these trades next week. Okay. Let's get to John's question here. John says, so differences between straddles and strangles are strike prices, and either can be short or long, and the answer is yes. Either can be short or long. Today, we're going to talk about short strangles. Last week, or short straddles, rather. Last week, we really were focusing on the long straddle with the same strike price. It just happened that we didn't get filled on this one, so I changed it. But yeah, they can be either long or short. Now, if you have a long straddle, like say we did on IBM, the most we can lose is what we put into the trade. Is that the same way with short options? It's not, right? The situation with short options is that we're not buying a hedge leg. If we were buying a hedge leg, then it would be somewhat similar to, say, an iron condor, except those we always do out of the money, right? A bear call spread and a bull put spread. So with a short straddle here, we do have unlimited risk potential. And that is something to be serious about, okay? In the event of a put, say we have a short put and the price of the stock drops, well, we know at some point that bleeding will stop, the losing will stop because the stock gets down to zero. But what about a call? If we're short a call, theoretically, there is no limit to how much we could lose, okay? I'm going to say it's not a common strategy for somebody to want to be naked on the call. However, we're exposing you to these strategies, and that's what this strategy is. So I'll show you some other considerations that we put into it. Oh, it looks like already we have a survey out in the chat. You guys know from time to time we'll put a survey out there. Brent and I don't control it, okay? Somebody else controls that, and they come out randomly. And we do like to have your feedback. We want to know what you're thinking. This is specific to our session here today. Obviously, we're not that far into it, But by the time we've closed our session or it's time for you to leave, if you'll just click on that link, fill out that short survey. There's 2 questions, multiple, you can put on a scale of 1 to 10, pop, pick the radio button that more corresponds to your expression of our session. And then there's 2 places that you can answer a couple of questions if you want to as well. And I'll also tell you, you can send a message to me there. If you want to say, hey, this is something I'm struggling with, or maybe this particular strategy you've got a question about, go ahead, let me know it there, because I like to incorporate your questions that you have, the input that you give me. I like to incorporate that into our upcoming sessions. Okay, so we will appreciate your feedback on that survey. I'll read every word that you put in, and we like to receive it. Okay, we'll remind you again before our session is over, and Brent will post it out there a couple of different times. In fact, I think he may have it posted up to the, or pinned up to the top of the chat as well. Okay, let's take a look at our first example here. And I'm going to kind of walk you through my thought process, okay? First of all, we're looking for stocks in a straddle situation that are going to make a big move, right? That's why we bought the long call and the long put. Well, if we don't think the stock is going to make a really big move, we might consider wanting to capitalize on selling that premium. Okay, so I went to the Market Watch tab, and that's what I did previously as well. And I wanted to see who was having some earnings. I also wanted to know who is going to be announcing soon, because hopefully the implied volatility has already had its ramp up, right? If they're going to announce this week, yeah, they probably have had a few days of implied volatility increasing, which should mean the premiums are a little bit juicier. And so there's a couple of tools that I looked at here. One, I was looking for big names. I'm looking for ticker symbols that you recognize, because they're typically the more widely traded stocks, okay? And so I just went through the week here. This week, we're going to be starting with a lot of financials, okay? They're going to be announcing. It's kind of going to set the tone, I think, for the earnings season. And so as you look at any of these, you click on Tuesday, you see everybody on Tuesday, Wednesday, you see everybody on Wednesday. That's kind of how I went through my process of trying to decide who are we, which stock are we going to use for our example trades here today. So let's start out with our first one, which is Morgan Stanley. So we'll bring up Morgan Stanley here. A tool that you want to have probably on your charts is this market maker move. Okay. If you don't have it, I'm going to copy it over to you right now in the chat. You'll want to have it. Remember, anytime we share a script with you, it's never guaranteed as to timing or accuracy. The part of the URL that you need is, you can grab the whole thing, except don't include my description that says MMM on chart, okay? You'll just use the piece here that's just starting with the exclamation point. Let's see if all of that copied over to you. Actually, not all of it copied over. You'll just use the part that starts with the exclamation point. You'll put that, you'll come up here to your open shared items under setup, and then you're going to paste in that formula, and then you're going to get rid of the stuff that I told you to get rid of. Right? That thing on the chart, we're just going to start at the exclamation point, hit the preview, and then I call it MMM on the chart. Remember what it is. If you want to change that name, change it. That's fine. But what does this do for us? Well, it shows us what the market maker move is for the upcoming event. In this case, it's earnings. However, it doesn't have to be earnings. It could be an FDA announcement. It could be a product announcement, say like on Apple. We just had that a couple of weeks ago where they come out with, I guess more than a couple of weeks ago, but they come out with their product line, and sometimes there's an expectation that the stock might move big. And so the market maker move is, what are the market makers pricing into the at the money options, because it gives us an expectation of movement. Okay. Now, right now, the yellow thing up here that says market maker move equals $5.50, which is about 3.55%. Would you think that a 3.55% move in the stock would be higher or lower? Do you think that's a big move? Think that's a small move for the event? Now, one thing that I did, and I'm not going to take you through this process on every trade, but I went back to see, did they move big in the past? Morgan Stanley has not had that big of moves. We can see here, just say the last earnings, because I've just got a 3-month chart up here. They typically announce before the market opens, okay? So before they announced last week, this is where it closed, and then they announced in the morning, then the market opened up. Looks like it gapped down a little bit, ran to the downside a little bit before closing up at the end of the day. So a little bit volatile on the session there. But the overall move was really not that big, okay? Let's see, how do you say your name there? Mary Bynes or Burns. Maybe it's Mary Burns. Hopefully I said that right, Mary Burns. Would love to get the ribbon on the top of the chart. Any chance of sharing your screen setup? Absolutely. Yeah, let me just share the chart with you. I'll show you what the red is, and that's what Mary Burns is referencing. Is it's showing us year-to-date move, month-to-date move, week-to-date move, which of course on Monday it's going to be the same as the week, and then some of the like the PE ratio, the yield, some information about the stock that you can just see immediately in front of your eyes. So that's the red. And then the yellow is this market maker move, 3.6%. And also these markings on the side, which I think is so helpful because it says, hey, what they've priced into the move is from, in this case, anywhere from 149 and some change to 160 and some change. Okay. Let me share with you also that label. I thought I might have it in my notes out here on the side, and I don't think I do. So let me share that separately because some people might not want the whole chart. Let me just come out to that label. I was actually using it this morning, and maybe I'm just going to give you a new share here. Oops. There's the script, and I'm just going to hit share up here. I'm going to say share. It's going to create that URL. And then I'm going to post it a couple of places. One, I'm going to post it in my chat or my Scratchpad notes. And then I will also paste this out for those of you that are here live so you can have that. Those of you that are listening to this on the recording, what you'll need to do is pause it and then go back and grab it, unless I do something else, which I'll do real quick here. I'll put it in a text box while we're talking about Morgan Stanley. That's a little bit bigger for you. Okay. And I said I'd share the whole chart setup, which I will. Okay. So this last one is my chart, okay, which will have the market maker move on it, as well as my moving averages and the labels that are in red. Okay. It'll get you the whole enchilada. Okay. Going back here, let's see. William says, in addition to MMM, could you use the implied volatility of 56% plus or minus 7.46 on the trade tab for the options expiration date? We're going to talk about that, William, because there is a little bit of a difference, okay? The earnings announcement here is going to be, I think, on Wednesday morning, right? We said this is going to be the 22nd. Can I get it to show up? No, this is the 15th. This is this week. Okay, so that's going to be Wednesday before the market opens. There's a little bit of a difference in that move. Okay, let's go to the trade tab now with Morgan Stanley. Probably should change my little link back here so it'll bring it in. And let's collapse this. So up here at the top is this yellow, this market maker move. I know that acronym to me is not looking clear, but that is two M's on top of another M. To me, it looks like, free weights, those barbells things. That's what it looks like to me. But the move they're showing here, 5.78, and that should be the same thing that's reflected back out here on the chart. Okay. And then it also calculates that. Now, what you're asking here, William, you're saying, well, could we also use this 55.78% and a plus or minus 7.45 move? The difference between the numbers is this one here is to all the way till options expiration. Okay, so Friday afternoon, basically. The expected move before the option expires Friday afternoon is about 7.42%. So you could use that. Well, you need to know that number's a little bit different than this move here of 5.79 because this is the event only for Wednesday. This one goes to Friday expiration. Okay, so it's nice to know what that difference is there. And you're right, they have a move priced in here. Morgan Stanley's $155 stock. So yeah, they're expecting a little bit of a move. But I was asking it kind of, do you think it's a big move or a small move? I'm going to say it's probably a smaller move. Okay. As we get into some of the tech stocks and we start seeing 8%, 10%, 12%, those are really big moves. Okay. And so as expectation of maybe a smaller move is why we might consider the short strangle. Again, I want to reiterate the risk that comes by doing naked call, naked put, because we'd be selling one of each of them. Okay. Very good. Let's get into this trade. So I'm going to open up the October options because that is the ones that trade this week, that expire this week during earnings. And if we're going to do, we probably don't need 50 here anymore. Let's maybe just go with 15. We're going to do an at the money straddle. That means we're going to do the same strike price at the money, which right now is 155.36. So the closest one's going to be this 155 strike. So setting up this trade, what I'm going to do is I'm going to hold my control key down on my keyboard. If you're on a Mac, it would be the command key. And I'm just going to hold it down while I click on the bid price of the call and the bid price of the put. Okay. And so this is going to generate a decent sized premium of 720. But in order for us to keep 720, what has to happen? Well, we want to have, as soon as the news is out, we know one thing's going to happen. Implied volatility is going to collapse. It's going to come out of those options. Well, to a seller, man, that's a happy face, right? We're like, yes, we collected it before the bubble popped and the implied volatility came out. We collected that premium. But we also are expecting it to not make a huge move, not go beyond 161 and change or 149 and change. We're expecting it to not make that big of a move. But what you're going to notice is this is pretty much what's priced into the straddle options. Okay, so if we come back here to the trade tab here, if we looked at the long option, 385 plus 360, yeah, that's about the market maker move. We're just having the other side of this. Now, I'm going to say it's a little bit wide right now. 325 by 360 is like 35 cents, right? Which is a little bit big, which is pretty close to about 10%, right? Because if it's 35 cents divided by 360, which is the ask price there, that's about 10%. Our expectation is actually probably to get it closer to the midpoint level, which Thinkorswim does for us automatically, right? We have the 712 here, and on this little bar, when you look at it, the right side here right now is showing the midpoint price, and then 680 is the natural price. So what actually is on the bid for each of the call and the put is about 680. Okay, so it goes and takes the midpoint price for us. Many times we can get filled there. Once in a while in a live market, you may have to adjust that. Okay, I might not fill you at the midpoint in a real live market. So you might have to come up here and maybe say, okay, we'll take a little bit less. Maybe we, put it down to 705 or something. But for the moment, we'll leave it at 712. Okay. We're going to go ahead and place this trade. The difference here in the long and the short is a couple things. The long has limited risk. The short does not. It has unlimited risk potential. The other thing is implied volatility is already priced into them pretty high, so we're hoping to capture that. Okay. Some of you may not feel comfortable doing this trade whatsoever, and I would be good with that. Okay. But I do want you to understand the strategy. Okay. We're going to go ahead. We're going to hit confirm and send. And I'm going to put it in our bucket of straddles and strangles. Okay. These will be where we keep our class account rates. A way to learn strategies, you guys, is to do this trade or another trade, mimic it in your paper money account. You can kind of follow along. You can see what's happening. Then you get those questions. You're like, well, at this point, the stock did this and the option did this. And what might we want to do? Or what might, you might go, oh, but I've got a question here. How do we handle this? Okay. My expectation on this one is that we're going to be out before we meet next week. One, the options will have expired. And two, we may have taken some action on it. For example, monitoring this trade. Let's suppose, obviously, nobody knows what's going to happen. Nobody knows what the news is. We all got to find out together. So maybe if the stock makes this kind of a move, say down, which our short call or our short put, which one's going to be in better shape? Short call, short put. Okay. It should be our short call, right? That is well below this market maker move here. So it should be sitting pretty. We will have implied volatility crushing out of both of them. But because the value of the stock is changing, that should change the premium, right? If the price is dropping. So we might find that one side is very favorable and the other one maybe not as much. Okay. It could be that the news comes out and we take action immediately, right at when it opens. It could be that we kind of let it move around a little bit, let the implied volatility crush out. It takes a little bit of time in the morning for that to come crushing out. We'll see a big drop in it, and then it's kind of like maybe it starts here and it crushes down, and then maybe just, kind of starts dropping a little bit as the day goes on. Okay, but we're not going to be in this trade by the time we get back. I'll report to you about what happened to it. Okay. Chris says on this one, the 2-point differences seems pretty high to me. I think what you're saying here, Chris, the 2-point differences, 161 and change and 149 and change, seem kind of big to you. They might be to you. But again, it's only 3.77%. In this case, what you might be saying, Chris, is that seems like a bigger move to me. I don't know if I feel comfortable with that, right? Is I think what you're saying, I would want maybe something smaller. That could totally be, okay? We are all going to have our own impressions, but I'm showing you kind of the data that I looked at. Last week when we did the long straddles, we went back and I showed you the big move some of those stocks had made, right? Those two stocks that we got into, Texas Instruments and IBM's. Usually they were making pretty big moves around earnings. This stock, not so much. Now the next stock, not it either, okay? So next one we're going to bring up here. Let's do something non-banking. Let's look at Johnson & Johnson. Now, the market maker move here is about 2.97%, so a little bit less than what we saw on Morgan Stanley, but kind of in the same range, right? It was a little bit above 3%, so this is a little bit below. And we might look at this move here and go, oh, yeah, maybe that looks kind of big, but it's not as big as what we might expect. And truly, if this stock maybe had a muted reaction and nothing much happened to it, we'd be thrilled, right? We'd be kind of, yes, happy days, okay? Their announcement is going to be a different day. Let's see, these guys are going to be the 14th before the market opens, so tomorrow morning. So tomorrow morning, I'll be paying great attention to this. I'll be seeing what happens pre-market. Do you guys know how to check on the stock pre-market? If you don't, you need to know. On our charts, if we come into the settings, come over here to equities, and I've got something here, show extended hours trading session. I have those checked so that when I look at a 1 day, 1 minute chart, it will show me the pre-market and it'll show me the post-market as well. These guys probably won't have anything post-market today because they don't release anything till tomorrow morning, okay? This gray area here represents pre-market today, basically, okay? And so we would want to be able to see that. If the stock moves down a little bit or up a little bit, we'd want to be able to see that before the market actually opens because it sets our expectation. It doesn't guarantee that it'll open there. It doesn't guarantee that it's going to stay there. But at least we have some initial reaction from the market that we have an expectation of, okay, the first response was positive or negative or what it might happen to be. All right, let's come over here to J&J. Again, here's the market maker move up here, 5.41. Not what it was here on our chart, 5.45. It's dancing around a little bit, right? Pretty dang close. Okay, same thing here. We're going to do at the money. So at the money at 190, that's pretty easy. It's going to be 190, all right? So again, I'm going to hold down my control key on the bid price of each of the call side, now the put side. And pretty much this credit is the market maker move, isn't it? Yeah, it's pretty much that 564. You're like, I keep hearing that number. Yeah, it's the market maker move. So we're trying to collect the market maker move. That's what we're trying to do here. Okay. We kind of went through the scenario a little bit more detailed with Morgan Stanley, but it's the same scenario here. Okay, so we'll go ahead, we'll hit confirm and send. We're going to send that to our straddles and strangles bucket. All right. These strategies might be something you get comfortable with. They might be strategies you're not comfortable with, and that is just fine, right? We're here to show you how the strategies work, show you how you could consider trading them. And you might make up your own rule structure for them. For example, you might put a definition on what you think is a small move. Okay, I'm telling you 3% move to me is small. But after you kind of pay attention and you see the reaction of stocks or what they do, you might come up with your own rule. Maybe your rule might be, at 5% or lower is small, or 6% or lower is small, or 6% or higher is big. Okay, that's why you want to paper trade these strategies so you get really comfortable with it. Art says, so the pre-market only shows on a 1 minute chart. It will also show on a 5 minute chart. Okay, if I go over here and I do 5 days, 5 minutes, then it'll show you the in-between, the pre-market, post-market, with all of this gray zone. Because there's a box there that I checked that says highlight. Let's go back here. Highlight extended hours trading session. So that's where the gray shading comes in. Okay, so it's really looking at the intraday charts for that. Okay, but it doesn't have to be exactly 1 minute. If you like 5 or 10 or 20, okay, you could do that. Take it back here to our 3 month chart. All right, let's see what other questions you've got going in here. Deacon says, do you mean 6% of the credit? No, a 6% move. When I was saying, for you, 6 and higher might be a big move. It was more not necessarily 6% equaling a credit of 6%, but just the expectation of movement, because this represents not a percentage of a gain of any sort. It is, they're expecting the stock to move 2.82%. Okay, kind of running around there a little bit. And so I was saying you might come up with your own rules based on that. So yeah, Rocco says the 4 hour works as well in the extended hours. Perfect. Could either side be assigned, and how can it be handled? Yes, either side. From right now, we put the trade in. Anytime hereafter, we could be assigned early. Now we're not likely to, but we could, right? Because it's a straddle, it's at the money. Had we done a strangle, which we'll start talking about strangles next week a little bit more so. Then we've got a little bit of movement, right? Because we might be selling out of the money call, out of the money put. Okay. So, you'll get a feel for that as you trade them. Let's see here. William says, if I get an illegal 100-ish buying power warning or placing short straddle in paper money account setting. So you're trying to do it, William, it sounds like in your paper money account, and it's saying they can't do it. Check a couple of things. One, if your paper money account that you've selected is an IRA, in those types of accounts, some strategies are restricted. So you would want to do it in your paper money margin account and not the IRA account. Okay. And for your live account, you've got to have authorization to be able to trade naked calls in this case and naked puts. Okay. You have to have that option power. So you have to ask for it. You have to be approved for it so that you can make, say, a naked call trade. All right. A couple of other things here, you guys. Have all of you become subscribers to our Trader Talks channel? I hope so. I hope you become subscribers. Why? Because then you can find our information, right? Let's see what Brent is going to be teaching today, if anything. I'm going to come up here to our upcoming live streams. Here's our class right now. Barb Armstrong is going to be up next at the top of the hour with trading a smaller account. You guys know that. James will be next. Cameron. Oh, maybe Brent is. Oh, he's doing he doesn't teach today, but first thing in the morning tomorrow, Brent will be doing trading futures. So we're doing that particular class first thing in the morning. But in order to find our content, man, it just makes it really easy. So you can do this. You can come in, you can see our playlists. And one of the other things I've been kind of promoting here a little bit is this bite-sized content of these shorter videos that we're creating, where you just come in and just learn a little bit of a concept. Okay, it's not a big long class on it. It's less than 10 minutes. You can see Barb's here was 3 minutes, James was 7 minutes, Cameron was 8 minutes. So those are kind of easy to consume, and you get to learn kind of these little nuggets in a short period of time. All right, back to questions. Deet says, when would I do a long straddle or a short one? So what I've been trying to emphasize here today is if you're doing a short one, it's because you're not expecting as big of a move. You would do a long straddle like we did last week if we're expecting a big move. And so for that, you know, one of the things I did is I went back on the chart to see, well, how much did they move in the last year when they announced earnings? Did they move a lot or did they move a little? Because if they have a tendency to move a lot, then the market maker's got to price that into the options for them. Yeah. So that's kind of the distinguishment between the two. As I said, we haven't done anything with strangles yet. We'll start doing strangles next week. Okay. The one exception is that I had to change our trade from last week to a strangle from a straddle because we just weren't getting filled because there was not a lot of open interest. That's okay. We'll still get to go ahead and follow it through. All right. So I'm going to encourage you to follow our Trader Talks. I'm going to encourage you to follow Brent and I on X. Get some extra content. Just you can read in a little quick second. And then I will remind you once again that they've posted a survey out there, and we always appreciate your feedback on the surveys, right? I read everything that you send. I like to hear your ideas. I like to hear your concerns. I like to answer those questions in upcoming sessions. So if you want to use, fill in the blank with information that way as well, feel free to do so. All right, Brent's posted that in there one more time. John says, is it common to pull one leg up upon big early event? Is it common to pull one leg? I think what you're saying there, John, is it common to get out of one of the sides if you get a big move? Yes. That's why I was saying, okay, if J&J tomorrow kind of comes down here, we will have captured a lot of that call premium, right? We will have captured a lot of it. So yeah, we might consider exiting separately. Absolutely. So I appreciate you making that clarification. All right, you guys, my time is up. We're going to take a little break. And coming up, Barb Armstrong is going to be doing trading a smaller account. You guys love that class, I know, because I get to do the chat sometimes, and I was able to cover for her when she was out having her knee construction surgery. All right, you guys. Brent, thank you for your help here today as well as our producers. Okay, you guys, we'll see you back here in about 20 minutes for trading a smaller account.